This episode of the Old Dawg's REI Network is brought to you by Mino Studio. Mino Studio is a pre- and post-production facility for all of your audio needs. Mino Studio's founder is an accredited audio engineer with top 40 and indie album credits. With over 30 years of music industry experience, Mino Studio can take your podcast from idea to reality. Contact Mino Studio at minostudio777@gmail.com for more information. That's minostudio777@gmail.com.
In a world where jobs are how most people make money, one man, one desire, one challenge dares to break the mold. Welcome to the Old Dawg's REI Network, where we don't work for money. Money works for us. Coming soon. Viewer discretion advised.
Welcome to the Old Dawg's REI Network, where cash flow is king. Real estate investing, the means, so you can enjoy your retirement dreams. This is the show where we cut right to the chase. No sales pitch, no long monologues, just simple how-to real estate investing advice, so you can earn the passive income you need to enjoy your retirement today. And now, your host and chief Old Dawg, Bill Manacero.
Well, good morning. We have a great show ahead of you today, and we are visiting with Michael Becker. Michael Becker is a principal at SPI Advisory, LLC, where he oversees all aspects of property operations, including asset management, property management, oversight, accounting and taxation, capital improvement and renovation projects, and investor relations. He's the managing member of around 3,000 multifamily units valued at over $200 million. And there's another 600 units currently in escrow. He's a 15-year veteran as a commercial real estate banker and has originated and managed numerous portfolios of permanent and bridge loans in all major asset classes. Over the last 5 years of his banking tenure, Michael focused exclusively on multifamily properties, where he has the #1 loan producer for his division at a top 3 national lender for his last 3 consecutive years. He is still very active in Old Capital and is still actively participating in some of the loans that are going on there today. As a portfolio manager, he directly oversaw the management and financial performance of the countless C and B class multifamily properties he originated loans for. In addition, he co-hosts the Old Capital podcast with Paul Peebles, a great broadcast that emphasizes individuals who have successfully purchased properties and grown portfolios in Dallas, Texas area. He's a lifetime resident of North Texas and a graduate of the University of North Texas with a BBA in finance. He is married and has 2 young children. Welcome to the show, Michael.
Hey, Bill. Thanks for having me.
Yeah, we're real excited to have you here. You've got quite a story to tell, and I gave sort of an overview of your background, but really love you to just tell us how you got started in real estate investing.
Sure. I'm as you mentioned, I'm a longtime banker, so that's kind of what I did for a living, and all I did, professionally was make loans on commercial real estate, specifically income-producing real estate. And like you mentioned, the last several years of my professional banking career, I just focused on Class B and Class C multifamily lending. And I realized every time I was making a loan, I was on the wrong side of the transaction. That it was better to be a borrower than a lender. And so I, kind of looking around at all the people I was making loans to, and a whole lot of them I knew as much or more about it than they did, and I just was wondering why I wasn't out there doing it. And I eventually met my now business partner when I made a loan to one of his clients. He was based in the Los Angeles area and had a client that he was representing that was buying a property in the Dallas area, and I met him when I made a loan to him, and we ended up forming our company about 3 years or so ago. Now we've been doing business, and we've done 3,000 units in about 3 years.
That's amazing. So did you just immediately start buying multifamily? Did you have any other investment properties, maybe smaller properties?
Before we met and started doing deals together, I did end up starting like most people did. I started out just buying like little rent houses, and I ended up about 5 or 6 years ago is when I bought my first rent house. I did that for about 2 or 3 years and ended up doing 16 houses over that time period, and they were all like rental houses. And when I transitioned over into the apartments, I realized that these little houses weren't quite for me, because every time I had one, I was kind of buying myself another little job with, because I self-managed them. So every time the garage door broke or the HVAC system went out in July in Texas and it's 100 degrees
Yikes.
outside, it was an emergency and I had to deal with it. And eventually I just decided it was best to sell all the houses, transition, and focus on, raising money and buying apartments.
So when did you buy your first apartment?
2013, so about 3 years ago now.
Okay. And did you set a goal for yourself at that time of how you wanted to grow it, how quickly you wanted to grow?
Sure. When I bought my first property, I was still employed at a large national bank, and I as a banker, you're kind of bred into you to be conservative by nature and have a plan and be very methodical. So I ended up I wanted to get critical mass, so I ended up doing 4 properties, about 800 units, but I still had a full-time job, and still had most of the rent houses at the same time as well. And so I wanted to get in and get a certain amount of critical mass right out of the gate. And my business partner had access to a lot of high net worth individuals in the Los Angeles and Orange County area. So we ended up joint venturing on, like I said, 4 deals, about 800 units just right out of the gate. And after I had that done, I knew I could kind of transition over and form our company officially and go for it. But, I wanted to make sure we had a good basis and a good level, good base track record. So when I made the transition and got rid of my W-2, my paycheck, that I had a high likelihood of success.
Wow! So your first year, you must have been over 1,000 units or close to that, right?
Right at it, yeah. We were just right at 1,000 units in the first year.
Wow.
That's right.
That's a pretty aggressive schedule, and holding a full-time banking job at the same time. I mean that's pretty crazy.
Yeah, I just kind of put my head down and had a mission I wanted to go out and accomplish, and just kind of focused on it, and just really just drove and worked a lot of hours and got it done. But it was important to me. It was critical that I had a good base when I left my job. I had a wife who stayed at home with 2 little kids and a mortgage and a couple car payments, and it's kind of scary leaving the full-time job. So I wanted to make sure that I set myself up and put myself in the best position to be successful.
Oh, that's great. Yeah. Now, coming from a banking background, I would think, boy, that's just the ideal experience. You know exactly what the underwriters want. You know exactly, how to position the deal so that it's appealing to those. I'm sure that they got involved in the lending part of it.
Yeah, that was one of the resources I was realizing that I wasn't using. Was I had. All I did for a living was underwrite deals and look at deals and go tour deals and look at the construction progress when they were rehabbing them, and had all this practical hands-on experience, and I wasn't out there utilizing it. And so I just felt like I wasn't using my full potential. So I knew I was in a much better position than the vast majority of people that start out into real estate investing, and specifically multifamily. I knew, everything I needed to know. I just needed to go out and actually get the guts and take action and go do something about it.
Now, you must have had a plan coming out of the chute in terms of what specifically you're looking for, what type of property, what the numbers had to be and so forth in order for those to be deals. What was that criteria, and is that the same criteria used today?
Sure. We've kind of evolved a little bit from where we started, but when you get started, you kind of do what you can afford and what you have the money for. And so a lot of what we did were Class C multifamily properties. So in Texas and DFW area, what that means is 1960s and 1970s built garden styles, like 2-story apartment complexes. That's essentially what we were focused on, and what we've kind of evolved into to now as I'm trying to go up the food chain a little bit of the quality of assets that we're buying. So we're focusing more on Class B right now and kind of selling our Class C. So trying to get rid of the 60s and 70s built deals for the 80s and 90s vintage properties. And so what that, main components that really are attractive to that is if you buy these older deals, you certainly have like cast iron sewers, where the 80s product generally has PVC sewers. So you got plastic sewers versus the cast iron, and over time, if you own an older property, the cast iron kind of erodes away, and you can get roots and other things into it and cause all these like sewer backups. And some of these older properties have aluminum wiring if they're built in the late 60s. So just little construction quality goes quite a bit up. And then you buy one of these deals, you don't have all these non-recurring expenses that keep recurring on these older deals. So we're really just trying to get better located, better quality assets. And so, what I focus on are Class B suburban multifamily properties. That's essentially what I'm looking for, that have either a physical issue or management issue, or generally some combination of both, that are 10 to 15% below market rental rates. We come in, buy them, fix them up, cure all the deferred maintenance, upgrade the units, upgrade the amenity sets on the properties by sprucing up the pool area or adding a playground or dog park or something along those lines. Come in, raise the rents, and that's essentially the basic business model that we go out and try to employ.
With all of your properties sort of in the same, is it the Dallas metro area or Dallas
Correct.
Fort Worth? Do you have your own management company? Do you use the different management companies? How do you handle that?
So we have 2 third-party management companies. So I personally believe, for myself and my situation, that life's too short to deal with the day-to-day management of it. It's a very critical function, very important, but it's the most the least glamorous side of the business. It's not very much fun. It's people business, both with your employees on site as well as interacting with the tenants and all that goes along with that. So we actually have 2 third-party management companies. So when we started out, we're focusing more on C property. We used one management company that's kind of specializes in Cs, and then when we do B-class properties, we kind of use a different management company that focuses more on the B-class properties. So we've kind of employed 2 different management companies.
And these are probably companies I would assume you knew over the years because of the business you did in that area.
That's correct. Yeah, I met them through my banking relationships.
So probably minimal amount of turnover in terms of the property management. I would assume.
Yeah, it's been the same companies. We've the property that we've had, they've been on there the entire time.
Oh, great. Sounds great. Are you, in terms of the Class B, now obviously cap rates are changing, right? You're going for a higher value property. Are your numbers still working for you in terms of what you're seeking to get for investors?
Yeah, it's certainly more challenging today than it was 3 years ago when we first started looking. It's a tough world out there, Bill. Lots of competition. I'm imagining that where I'm located in Dallas Fort Worth is amongst the most competitive marketplaces in the entire country for this type of product. And we have a whole lot of supply here in DFW, but there's certainly a lot of demand for this type of product, including a lot of guys from your backyard. Southern Californians seemingly own half the property here in Dallas Fort Worth.
Yeah.
I'm exaggerating a little bit, but there's a pretty high percentage of people from California that look at a 2 or 3 cap property in Los Angeles in the hood, and can then exchange that to go buy a nice B class property in the 6 to 6.5 cap range and more than double their return. So it makes a whole lot of economic sense for people to kind of flee California or other parts of the country to come to Texas. So we have quite a bit of competition on our properties. To your point, certainly the cap rates have compressed, so meaning you have to pay more for the same revenue stream, but at the same time, our rents have escalated quite a bit, like most of the places in the country, and the debt term's still pretty darn favorable. So you're borrowing money today, you can do 10-year fixed rate, Fannie Mae loans on an apartment complex and be in the low fours.
God, that's awesome.
Which is pretty attractive. So if you could buy on a 6 cap and borrow 75 to 80% of the money at 4%, then you got a pretty positive arbitrage on what you're getting paid by your tenants, so what your debt costs. So if you can, be positive on your debt to your cap rate arbitrage, then it's pretty simple business as long as you live as long as you own a property in a decent area where people want to be and you have good quality management. That's a pretty good start of making some money.
Are you ever looking in other cities outside of the metro area, in Texas or other states?
Yeah, I've spent some time earlier this year. We flew up to Nashville, looked at a few properties up there, and really liked Nashville quite a bit. But the story, resonates. It's growing quite a bit. It was a little bit more expensive from a little lower cap rate perspective than what I have at home. And so for me to go somewhere else, needs to be attractive. So I think one of the places I'm seriously starting to consider is Houston. Mm-hmm. I think Houston certainly had some economic challenges over the last several months, year and a half or so, just with the decline in the oil prices. So I think there might be some opportunity down there where you can go in and buy, something that's struggling a little bit at a pretty decent rate and operate it with and get a pretty decent value down there. So I'm just starting to kind of figure out what submarkets I want to start looking at. And I think we are going to try to make a play in Houston. That's a logical place for me because that's about a 4-hour drive from Dallas, and I can get down there pretty easily.
Now, as a banker, tap into that expertise here. Rates are amazing, especially if you can get some of those Fannie Mae non-recourse type loans. But what do you see rates doing for the next couple of years? And do you factor that in?
Yeah, we typically have always taken, or always, or the vast majority of the time when we go out and borrow money, we're doing 10 or 12-year fixed rate loans, taking the kind of like the long-term approach. And when you buy a property and get a long-term fixed rate loan on a commercial building, generally they have large prepayment penalties. So, essentially the loan is in place for the term, or you have to have a loan in place for the term, or you have a big, large prepayment penalty, so it kind of makes the economics of the deal get screwed up. So when when we go sell these properties, we have to sell them as like a loan assumption. So when someone has to come in and assume our loan, and for the last 3 years, I've been wrong on every single decision I've made because the rates have stayed low. So I'm thinking that we do have. I'm looking at my crystal ball, and if you're asking me to make a prediction, I think rates are going to be low for another extended period of time, for another multiple years. However, with that said, we're generally still going out and taking 10 or 12-year fixed rate loans because you can get them. So instead of paying around 3%, for an adjustable or floating rate loan with an open prepay, you pay about 4 to 4.5 for a 10 or 12-year fixed rate loan. And I'd rather, I got a lot of things to worry about every day, Bill. And one of the things I don't want to worry about is what happens if I'm wrong and rates go up. So
Right.
I'm kind of protecting my downside more than trying to maximize my upside. So if rates do rise, or if I do have like a short-term maturity and happens to be at the wrong time and I got to refinance in, say, 2009, the new equivalent 2009, and you had to go refinance when the capital markets are frozen, that's not a good thing. So I'd rather have a long-term fixed rate loan. So I know if I happen to be buying right now and I look back 6 months and saying, why did I buy at the peak? Then, I have a long-term fixed rate loan. So I just kind of hunker down and ride out the whatever cycle's ahead of me. And I come out the back end with my shirt still on my back.
Sure. Well, with the B class properties, are you looking at those as long-term holds, or are you, do you have a 3-5 year plan or a 10-year plan?
Every day is a little different, so it kind of really depends on how we source our equity. So we have a couple ways we generally source our equity. One is either we'll go out and do essentially like a joint venture. So we'll get one high net worth individual and kind of partner with them and buy the deal. The other way we've done deals is kind of what we refer to as syndication, where we'll go out and get a pool of people together, and everyone puts in $100,000 and you raise money from multiple people, 10, 15, 20, sometimes more. And you put your money together, and it was, syndication is what we call it. So usually if we're doing a joint venture and our partner wants a long-term hold, that's kind of what we focus on. If we do a syndication, usually when you have 15 or 20 unrelated people, they're going to want to see a light at the end of the tunnel and want to see a path to get their money back. So when we're doing deals like that, we usually, pro forma about a 3 to 5 year hold and try to sell those deals.
Okay. And do you ever look at sort of refinancing at that point, paying off the investors and continuing to hold, or is that ever an exit strategy?
Yeah, there's certainly an exit strategy. With we typically take out 10 or 12-year Fannie Mae loans, like I mentioned. And one of the unique things to a Fannie Mae loan on the multifamily side is they allow for what they call a supplemental loan. So what that means is you come in and they'll give you a second lien cash out loan without paying off your first. So if I have a 10-year loan and 2 years into it, I raise the rents quite a bit, and by extension, the net operating income and the value, they'll allow me to re-leverage up to 70% of the new value and cash out. And I can, just take that money, and then we've done that before where we cash out with a supplemental loan and just pay our investors back and hold the deal. So that's certainly a very viable exit strategy, or a strategy to return capital to your investors. So that's certainly a tool in the toolbox. But like I said, if you have 20 or 30 people into a syndicated deal, usually they're going to want a path to get their money back, right, in a reasonably short period of time. So it's a whole lot of it depends answers, and it just really depends on the situation, the type of property we have, what we feel like. We are in the economic cycle. Am I in the lower end of the acceptable range from a location, or I'm in the corner of Main and Main, and I know this is like a very irreplaceable location, so we want to make sure we hold it for the long term. So this it kind of really depends on the specific deal.
What percentage would you say are syndication as opposed to JV of most of your deals?
We're about half and half. So we've done
really?
half of deals with one investor. So we essentially have three high net worth individuals that we will syndicate, or we'll do a joint venture with, and then the other half of the deals we've done have been syndications where ranging from I think 5 on the low end upwards of like 55 people on one of the syndicated deals on the high end raised about $8 million on a deal. And we had 55 people to get there.
Wow. Now, are the syndication deals structured pretty similar to each other in terms of what you're paying to the investors, the equity?
Generally, they're set up pretty similar to each other. Usually, when you have one guy stroking a check, they usually command a little better deal, a little lower structure, or a little better structure, more favorable for them versus me having to go out and get 55 individual people together. It's a whole lot more work on me than to get 55 checks than it is to get one.
Oh yeah, I would imagine, and then managing all those investors too. That's a big task.
It is.
Looking at what you've done thus far since 2013, wanted to take a look at sort of your biggest learning opportunity. I don't want to say the biggest mistake here, but something that happened that kind of hurt. Now, with your background, it seems like you would have few mistakes because you've worked with so many other deals with people on the lending side. But what would you say, in terms of I really learned from this one?
Yeah, I think I'm fortunate enough where I haven't really. I'm knocking on wood here. I don't believe I made any sort of major or fatal mistakes along the way. Certainly, I could have done many things a little better. Some of the ways I've kind of involved when we were first doing syndicated deals, we would, get our private placement memorandum, or PPM out, and then we would just send it out and have individual one-off phone calls with everybody. And as we've kind of grown, that's been quite a chore if you do it that way. So what we've kind of focused on now is we'll go get our private placement memorandum, get the people on our list, people that we have relationships with, and then we'll set up like a webinar on a Tuesday night at 7:00, and then we'll have a webinar that night and record it.
Oh, that's great.
So we can have multiple people on the webinar, and then we record the webinar, and then if you happen to be busy at the time we have the webinar, it's recorded, you can listen to it, and it usually answers 95% of the questions, and then you can have a 5-minute phone call with somebody instead of having an hour and a half long phone call to go over the deal. So that's kind of one way that we've evolved. I guess one of the biggest mistakes I made was one of the first syndicate deals I did. We were going to go out and I was going to rebrand the property. So we bought a property that was underperforming. We're going to update the signage package, so we're just going to change the name. And I put that out to kind of the peanut gallery and try to get some feedback. And that was a horrible mistake, and I got a bunch of feedback I quickly realized I didn't want. So from that point on, we internally have a discussion. I just let all the investors know, hey, this is what the new name's gonna be after I made the decision and showed them the new logo. So that's kind of one of the, but if that's the worst thing I've done, I think I've been pretty fortunate not to make any, critical or fatal mistakes along the way.
Yeah, that's not too bad. How would you? What about in terms of maybe your biggest success? Something that just, wow, this deal just went over the top.
We've had a few, pretty good success stories. I mean, the one that sticks out the most is we bought a property in was in May of 14, so I guess right at 2 years ago now. And we ended up buying it for like $33,000 a unit. It was in a submarket called Irving, which is right by Dallas-Fort Worth International Airport. And it was just, completely mismanaged, long time ownership. He self-managed it, 260 units, and the gentleman who was running it had 5 down units, meaning that he had such bad roof leaks. So instead of just fixing the roof leak and getting the unit fixed, he just let the roof leak happen, and he stripped all the drywall out of the unit, so it was kind of down to the studs. As well as he had 5 employees, plus he was a horse enthusiast, so he had one of his jockeys living for free into his unit. So out of 260 units, he had 11 units that were not producing revenue, as well as, the rents were really low, and he wasn't billing back for water, sewer, trash, pest, and gas. He wasn't, billing back to the residents for the utility usage on the property. So we ended up taking it. We've doubled our net operating income in the first 18 months. And by extension, we doubled the value of the property, and we're able to, I think we had about $2.3 million into that deal in equity, and we're able to get one of those supplemental loans I mentioned about 20 months or so after we owned it for $4 million. So we're able to still own the deal with the 70% loan to value and pull out, 180% of our original investment. That was a pretty good deal. Hopefully I can find another one like it, but certainly the times have changed, so those are getting harder and harder to find nowadays.
What was the time frame on that?
We bought that 2 years ago.
Wow.
May of 14. So we I think we pulled our loan out in February is when we closed on that. February or early March, one of the two. So about 20 something months into it.
Wow. Yeah. When you were saying you were dealing with a guy that raced horses, I was thinking some of the units were used for thoroughbreds or something. And
that would be worse.
Yeah, I think so. You'd have to give them at least a pet deposit or something,
Yeah.
Looking at your current business and where you're at, where do you want to see your company go in the future and your role in that?
Yeah, that's kind of something we're spending quite a bit of time on right now. So I think we're essentially what we're actively working on is 4th employee. The 6 of us work in the company, so my partner and I have 4 employees, and we are really just trying to focus on systematizing it. It was kind of felt like we were just a couple guys out there doing some deals, and all of a sudden we woke up and we have a whole bunch of properties that we need to turn into an actual company. And so that's kind of a lot of what we're going through right now is getting systems in place and an investor database to manage it. So we have a actual database versus having like a spreadsheet where we track everything. So we're kind of working on some of our technology to get it a little bit better so we can be more efficient with it and have it kind of more centralized locations where it's just easier to access wherever. If I'm here in the office or I'm out on a property and need to find something, we have very efficient way to do that, as well as work on having better communications and having newsletters and prospect a little bit better than what we typically do or what we currently do. So that's really one of it is we just need to get all these $10 and $20 tasks off my plate and hire out people that can handle a lot of the kind of the day-to-day minutia. Let me focus on what I think is the most critical, aspects, which is raising money, finding deals, and operating the deals that we have. So those are really the 3 things I need to spend my time on, and everything else is just kind of noise.
Where do you want to see the company in 5-10 years?
I'm not quite sure exactly where we want to be. I'm trying to get through this year and next, but I think really, if we could kind of sustain around 4 to 5,000 units and just get the right type of units in the right locations, that's probably where we'll be. And we'll just kind of every year churn a few deals in and out every year and just kind of stay around the 4 to 5,000 unit range. I certainly I would like to see myself in a second, maybe even a third market in 5 years. But I think by end of 2017, it would be nice if we can go into a second market and get a little bit more diversified versus having everything here just in the DFW area.
Yeah, I mean, that's definitely a lot different. You got to know that area really well where you're at, and going into a new marketplace, you get sort of to build your boots on the ground and establish the contacts and the people you can trust to do the day to day. So that's a great move. Great move.
Yeah, it's hard because I feel like I know everybody I need to know, and I know what I need to know about the locations here. And going to a new market, you got to take it slow and make sure you're methodical about it, and that you build the right relationships, because all the relationships I have were over years and years and years of doing deals, either as a banker or on the principal side now. And to replicate that is not going to be something you could just do overnight. You gotta really work at it, and it's going to be a process. So that's we need to be slow and steady about how we do it, and make sure we pick the right market and then the right sub markets within that market. Because if you just buy a bad location, that's pretty hard to overcome.
A lot of our listeners are 50 plus in age. Some of them are approaching retirement and seriously looking at real estate investing as a means to be able to supplement their income and to sort of grow a family legacy. Some are already in retirement. Some are already investing, but they want to, expand what they do and be better at it. What kind of advice would you have for folks that may be on a fixed income or, maybe limited reserves? They may have a little nest egg set aside, but they want to be wise with what they have, and they don't want to waste it or take chances with it. How would you advise them getting started or trying to grow what you may have already established?
Couple things. I mean, you don't need to shoot for the moon if what your goal is kind of supplement your income. One thing maybe worth considering is if you can buy just a simple little rent house in a good area that produces positive cash flow on a monthly basis. So if you can still find that in Texas, and there's many markets across the country where you can find that as well. I'm sure like Indianapolis and Kansas, and it's kind of hard in Orange County where you're located to find a property that makes sense from a cash flow perspective. But you do something like that, and you can buy $100,000 house and it produces $1,000 a month in rent. That's a pretty good starting point right there. You can hopefully produce $300-400 a month in net positive cash flow with $20,000 down, something like that. I think that would probably be a reasonable place to go. You can certainly hire third-party management companies to manage that deal. If you want to do more like what I do and invest in like a syndicated deal, getting to know people that are deal sponsors like myself and making sure you meet them. You need to maybe go network at local real estate investment clubs. I'm sure in any major metro area there's certainly likely going to be a real estate investing club where someone in there does kind of what I do for a living. So just make sure you get with somebody that has a decent track record that appears to be ethical and honest, and that's probably a pretty good start. And make sure that when they're explaining a deal to you, they can explain it to you concisely and as a very simple, straightforward play. Usually what in my experience, the most complicated deals are usually the worst ones. The deals you can explain in 2 minutes are usually the best ones. So that's kind of what I always focus on, just simple deals that make sense. So that'd be kind of, I guess, my advice. Either look to buy something on your own account. You can just kind of start small, or if you want to get in a syndicated deal, just go out, get networked, and make sure you meet people that are honest and have a track record of success.
Great advice. On the syndications, are you only dealing with accredited investors, or do you have others that can get involved?
We typically do accredited investors, but we have done some deals where we'll take what they call sophisticated investors as well. To date we haven't done any general solicitations. We've only done what they call 506Bs, which means that's the SEC code where you have to have the exemption where you can go out and do private placement memorandums and raise capital. But one of to be compliant and follow the rules, the way you do it under 506B is that you have to have a pre-existing relationship with somebody. So I couldn't meet somebody off the street and then throw them to one of my deals. We are considering doing what they call 506Cs, which is a recent change in the law about 2-3 years ago when they did the Jobs Act, which most people kind of think of as like crowdfunding. You probably heard of as crowdfunding, where then they have certain rules and requirements where you can only take accredited investors, and you got to take reasonable steps to verify that they're accredited. So we're thinking about maybe doing that, doing a 506C and using them, all these services that will go out and verify that investors are accredited, and then you can go out and advertise. We just haven't decided to do that quite yet. But that's probably on the list of things to do in the next 12, 18 months for us.
Great. At this point, we have our wrap-up where we just ask you a series of quick questions, just again for information and purposes and things that'll be valuable resources to our listeners. So kind of shoot them at you real quick here and get your responses. So I hope you're ready. Okay. Favorite real estate book?
Really, I like the two Ken McElroy books, the ABCs of Real Estate Investing and the Advanced Real Estate Investing Guide, I believe is what it's called. But I've been fortunate enough to meet Ken and kind of become friends with him over the last couple of years. So I really like both those books as part of the Rich Dad books.
Great. How about your favorite business book?
Favorite business book? I don't really have one, I guess. I just really read real estate books. I'm not the biggest reader. I'm more of a voracious podcast listener, and that's really what I spend most of my time doing.
Here. Well, then that kind of moves us into the next most valuable websites that you might access, and not counting your own, of course.
Yeah, I don't really, I'm not sure about the websites, but maybe some of the podcasts that I do listen to besides the Old Capital Real Estate Investing podcast, which you can get on iTunes. But the Real Estate Guys, I listen to their podcast quite a bit. I've been on that a few times, as well as I really like Creating Wealth by Jason Hartman. Those are some of my favorite podcasts out there as well.
Great. Well, we hope that you'll add Old Dogs to this, somewhere down the road here. Yeah. Okay. What about internet? Well, let's see, more of like an app. Do you have like certain apps that you use that really help you in your day-to-day business?
No, I don't have that too much. We use quite a bit of Google Docs. So, Google Docs or Google Sheets as a way, until we build our database, that's the way we track a lot of stuff. So I'm constantly using the Google Docs app quite a bit. And we use Dropbox is where we secure a lot of stuff. So Dropbox is kind of file sharing thing where, you can securely store files and have, access to it through the web.
Okay, great. And if you had to start over knowing what you know today, and let's say, something happens, cataclysmic thing, you only have $1,000 in cash, but you want to grow a real estate investing business, how would you invest that money?
Yeah, knowing what I know, I would certainly what I would probably do is start going to local real estate investment clubs, getting around like-minded people that have similar interests, and certainly if I have all the knowledge in my brain, just go out and start marketing myself to other people, find a partner that has a little bit of money that can front for me, and go out and get a deal tied up, raise capital, and close on it. That's essentially what I would do. Everyone starts from somewhere. Everyone has what they have. They have the resources at their disposal. Good education, listening to podcasts like Old Dogs or maybe some of the other ones I mentioned are a good start, but you got to get out and go get networked, and if you want to go out and raise money or find someone that does raise money and invest in syndication, no one's going to come to your front door, knock on it, and give you an opportunity. You got to go put yourself out there and get networked at local events, or even go into certain seminars around the country. I'm a big believer in that, and I've gone to many seminars and taken weekends away from my family to go out and do it. So those are some of the things that are either free or pretty inexpensive to go do, and just get around and have a bunch of conversations, because you never know, the next person you meet could be the key to the whole thing for you and could blossom into something that you never thought it would be.
Yeah, that's excellent advice. Networking and making those one-on-one contacts is critical in this industry. So that's great. How can people reach you, Michael?
Sure. I'll give a couple ways. You can certainly go like I said, we have a podcast. It's an iTunes Old Capital Real Estate Investing podcast. That's one way, as well as you can go to my company website, which is spiadvisory.com. It's SPI like spyadvisory.com, and all my contact information is on there. And that's how we operate the apartments and raise money. So that's how you find me there as well.
Great. Well, gosh, Michael, this has been a incredible interview. It's so much good information. I'm glad you talked a little fast because we were able to get a lot of information in there, and I think there's a lot to chew on for people. Hopefully, they'll listen to this podcast over and over and take notes because there's some very valuable information there. And I appreciate you for coming on. But of course, I don't let you go yet until you got to do your old dog howl here before we close out. And so I will just go ahead and just let loose here. Your best old dog, old hound dog. I mean, for Texas, there's got to be hound dogs around, right?
Yeah, I'll do my best here. So.
Okay.
Ready? Oh. There you go. That's all I got of me.
All right. That was good, Michael. Thank you so much. I really appreciate your hanging out with us. And for all our fellow old dogs out there, again, we just want to wish you the best. And we'll stay in contact with you through your Old Capital. We're old dogs. We go to Old Capital. And we'll listen to your podcast. It's one of my favorites, really. I love your broadcast and have some great real-life people there that share their experiences. So I think that's a great place to make contact.
All right, Bill. Appreciate the time. Thank you.
Thank you. Have a blessed day. I just wanted to take a moment just to thank you so much for coming by and listening to our broadcast here at the Old Dogs REI Network. We really appreciate it. We know there's a lot of things you could be doing with your time right now, and the fact that you have chosen to come here and listen to our podcast, we are very appreciative. As you know, we're a new broadcast, and we really want to get the word out and let people know what we're doing. So hopefully we can be a resource to help those that are pre-retirement or retiring that are looking for ways to build their cash flow. One of the best ways that you could help us out is to go to iTunes, look up Old Dogs REI Network, and that's spelled DAWG, and subscribe to the podcast, listen to a podcast or two, rate them as a 5-star rating, and leave a review, write a little review, and we'll be monitoring those and reading them every now and then on the show as well. You could take the time to do that. We would really be grateful. Thank you so much, and have a great day.